All right. Good morning, everyone. Thanks for joining us today, monthly webinar. So our run sheet today is Andrew Hunt, Ian Bellew, and then Tim O'Lone. So Andrew Hunt is coming to us from northern Italy. So thank you very much for that, Andrew. Just a couple of logistical things for everyone on the call. So the Q&A function is alive and well. So if you want to ask a question, then just type it in, and I'll curate them. We'll take the questions at the end of each person's section, as opposed to the full panel review that we ran as the stand-up last time. And just a reminder for any press that are on the call, please recall the guidance and rules from Jez Jones and Sharon as regards to the use of quotes, but come through to us directly afterwards if you would like to check anything that we've said or get clearance to use that elsewhere in the media. So with that said, Andrew, thanks for joining us. We will share your slides, so just keep us up to date with where you want to go with that. And over to you, Andrew. Thank you.
Okay, thanks, Rib. Yeah, good morning. Starting with page two, I suppose not to. We'll skip the photo of my travels after I left New Zealand last time and found myself at the Plaza Hotel in New York, which I think, needless to say, I wasn't staying there, but I think was quite appropriate given what was to come next. Because if we look at page two, I think the world that most of us have operated in, certainly that's really been in existence for the last 40 years, since the 1985 Plaza Accord, was a world that relied on ever expanding capital flows, sort of exponential growth in capital flows that funded budget deficits the world over, funded current account deficits, funded mortgage growth in Australasia. It certainly, I think, was the dominant feature of the world. It followed the financial deregulation of the early 80s. These currency accords were designed to make capital flows easier. And it really lifted the financial constraint from so many entities, households, companies, and of course, governments. Um, I think it was the defining feature of global economics for the last 40 years. And I think the question we have to ask ourselves is that world over? There's, of course, much concentration on tariffs, what the tariff rate will be, when they'll happen, will there be a continued pause? We've got Scott Bessent winding back some of the rhetoric at the moment. I'm not sure how far that will go. I suspect his boss will have an opinion on that at some point. But at the moment, we have that uncertainty, and that's certainly an issue for the economy. It certainly contributed to the decline in US GDP in the first quarter, mainly by lifting imports. But I think, in a way, that's not the central story. To me, the central story is, have we destroyed trust in the world that we've lived in for the last 40 years? Do we think there is a level playing field? Do we think the rules are clear, transparent, or are they opaque? Are they being designed to favor one group, particularly the US or certain parts of the US? And is that world that Rubin Summers, Greenspan, and Bernanke created still valid? And I think that there's certainly a very big question over that. We talked about this during the summit sessions, which, believe it or not, only, I guess, a month ago. But I think a lot of the trust in the world was destroyed by, and if we move on to page three, by that fiasco in the Rose Garden. Rather embarrassingly, the author of that particularly mad table actually used to be a client of mine. I'm not quite sure where they got it from, but to me, the question is, has that shaken people's confidence? As I think, as I remarked when I was down there doing the presentations, if you're investing in your domestic markets, you probably have a trust in the rule of law, corporate reporting standards, that it's I say, a reasonably level playing field. But the rather arbitrary nature of those calculations in that table, I think, has shocked us out of believing in that. And as we hypothesized a month ago, if you lose trust in international investing, you tend to bring your money home, you have a repatriation. And in that repatriation world, you would imagine that the countries who are savers, who have net foreign assets, will tend to see their asset markets re-rated, and those that are borrowers, the overspenders who've borrowed money through those capital flows, tend to be derated. So if we think of the last 40 years, the economies that have perhaps performed best, particularly US exceptionalism, as a lot of people call it, was about taking money from stodgy savers and spending it. That really was the story of the US. Yes, spending growth was rapid, earnings growth was rapid, using other people's money to support current growth. If we enter into a repatriation world, then you'd think that will reverse. And we've seen some of that this year already with the outperformance of Europe, certainly in the early part of the year, suggesting we are in that world because the US is the biggest net debtor, both absolutely and relative to its GDP. It's relied on capital flows that were typically 8, 10, 12, sometimes 16% of its GDP to fund its current account deficit and also to fund the US's appetite for buying things overseas. Think of all those tall buildings in financial centers with the names of US financials emblazoned on the top. Um, yeah, the US has had this massive financial reach, but it did so by borrowing other people's money. So if we're entering into a repatriation world, you'd expect that table to be turned on its head, that the savers outperform. They're the ones that tend to have the stronger currencies, and their markets tend to be re-rated relative to the debtor countries. And unfortunately, New Zealand is one of those debtors as well. Now, I wouldn't take a big position, an aggressive position at the moment, as we're seeing currencies are very volatile. That's down to two things. The first thing is just a lack of liquidity. So much capital has been withdrawn from market making, even the currency markets, that you tend to find that relatively small transactions can move prices quite a long way. I gather New Zealand Super Fund decided to hedge its dollar exposure, and that kicked the New Zealand dollar higher quite substantially for a few hours. We are in quite a liquid markets, but also we should remember that if everybody is repatriating, there will be flows going in both directions. And some countries have more liquid assets than their liabilities. And in particular, the US, a lot of its foreign liabilities might be foreign holdings, say Chinese holdings of treasury bonds, but there's an awful lot of foreign ownership of US private equity, of US property, and other assets that are actually quite hard to liquidate. And that tends to slow the process down. Whereas a lot of the US's assets abroad are actually in the form of dollars lent to provide trade credit, loans, some of which are quite short term, as well as equities and bonds that can perhaps be sold faster than some of the private equity. So even while we might be in a repatriation world, and I think know where we'll be in a year's time with the savers having been re-rated, in the near term, I'd caution against taking big positions simply because at the moment we know US banks are repatriating probably faster than anybody else. We know Japan's banks are taking money out of the US, but we calculate US commercial banks have sold about or reduced about $500 billion of their overseas exposure year to date, which at times supports the dollar. We saw that earlier in the year, actually seen it in the last few hours as well, where the weak dollar story really hasn't worked. So I think we should bear that in mind, that in this period of regime change, particularly with these relatively illiquid markets, we will see very choppy trading. I'm not particularly concerned about the outlook for risk assets over the next few weeks. There's not a lot going on in terms of news flow. We're waiting to see just how much damage has been done to the global economy by the tariffs and the threat of tariffs, and indeed by the start of capital repatriation. And also, we haven't got a lot of borrowing by the US government at the moment. If we can move on to the next slide. I think we've had the initial burst of the crisis. We saw the dollar weaken and equities weaken. That scatter chart, I think, goes back about 30 years worth of weekly data, and we were something of an outlier there with both the equities and the dollar weakening. a lot of people were expecting US markets to rise as the government spent its cash balances, and they did indeed spend those cash balances, but it didn't work because that injection of money through the cash balance, through the spending of the government's cash balances, was just used to fund the repatriations, and we've had that moment of illiquidity now. CLOs are a relatively esoteric part of the investment universe. They sold off very heavily, but what was scary about that was only a $600 million redemption in an ETF that caused a $1.3 trillion market to suffer that sort of correction and that sort of rise in yields. So, again, speaking to this notion, there's a lot of volatility in the short term, but I think will be up and down for a period of weeks without too much direction. But moving on to the next one. This, I think, is where things perhaps get a little more interesting, perhaps towards the middle of the year, in that if foreigners are no longer putting money into the US, or not putting as much money in, or not putting money in on a net basis, then it's going to become much harder to fund the US budget deficit. Now, across the world, countries need to close their budget deficits. I don't think there's much doubt about that. They ratcheted up during the global financial crisis, and they ratcheted up even further during the pandemic, and they haven't really been coming down since. And the US is certainly borrowing, its government is borrowing much more than the household sector saves. And that implies that you've either got to get money from abroad, or you've got to get people to save more, or companies to forego investment and save, or you've got to actually cut your budget deficit, or if you can't do any of those, you end up printing money. Now, I think we can safely say that following the timer has just gone off on the lights in the camper van that I'm sitting in. I'm back with you. We can safely say that I don't think foreigners will be funding that extra bit of the deficit now. So that does lead us to expect high yields in the near term. And I think when the US government does issue bonds, we will see the Treasury market sell off at a time when the economy is quite weak, and that could become an issue for equities. So although I'm not terribly nervous about the outlook for markets for the next few weeks, by our calculations, around about mid-June, give or take a few weeks, Uncle Sam will be needing to borrow money. They'll have depleted their cash reserves. There's seasonality involved as well. At the moment, they've got tax receipts coming in. They don't tend to get much in the way of tax receipts during the middle part of the year. So we could see quite heavy government borrowing round about June. I think that will push yields up. And against the background of that weak economy, that's probably another stress point for markets. So we could see some volatility there. Probably more concerned about the US than others. The US has been trying to tighten fiscal policy, and indeed they did get the budget deficit down quite dramatically in the first 4 weeks of the presidency. But that was largely through the expedient of just not paying bills. You saw payables explode on the federal balance sheet, which of course wasn't very good news for the corporate sector that was selling stuff to the government and not being paid for it, and that's part of the recession, I think. Or the weakness we saw in the first quarter. Unfortunately, payables ultimately have to be paid, and that's what we're seeing now. So the budget deficit's going back up again. So again, I think we will see higher yields as a result of that. Less worried about in Europe, because the European Central Bank quietly, really without telling anybody, has gone back to what amounts to a quantitative easing. We've got the European Central Bank. It isn't actually buying bonds itself, but it's lending money to the European commercial banks, who are then buying the bonds, riding the yield curve. In effect, they're borrowing short and lending long into the debt markets. That is funding Europe's budget deficit. So I think we will see higher yields in the US mid-year, probably more so than elsewhere. And that probably, as I mentioned, does cause some concern in markets, unless somehow Scott Bessent has managed to placate everybody, convinced everybody that the world is still the one they knew. It's all a bit of a bad dream over the last few weeks. Now, I think that's pretty unlikely. One of my clients put it rather succinctly. I think once you squeeze the toothpaste out of the tube, it's not going back in. And I think the administration is already has squeezed the toothpaste out of the tube, as it were, with these capital flows. So when they do come to the markets mid-year with some issuance, I think that's when we see some stress. Now, if we can move on quite a few down towards China, just conscious of the time here. I think we know the US is weak, and so there we go. Now, I think people have been surprised by China's response to the tariffs. It does seem to have been quite aggressive, the reciprocal tariffs, as it were. And I think there's probably a sense in Beijing amongst the leadership that the economy in China is weak. Now they have a scapegoat, and actually there's some mileage for them, at least politically, in appearing quite tough, because they're, in a sense, generating an excuse for what is already a weak Chinese economy. A lot of people, I think I've probably lost count of the number of times you read that China is about to launch a huge stimulus package, big bazookas, and all of this talk that's supposed to happen, and yet it never does. They eased for about 6 weeks last year and then stopped again. And I think the reason for that is China's economy is actually in quite a fragile position. It's got a huge problem with the amount of money that's been generated in the last 15 years. China's debt growth to fund its economic growth has been simply immense. The banking system is relative to the size of the economy, one of the biggest in the world, if not the biggest in the world. In fact, we worked out once that China owns a third of all the bank deposits in the world, despite being only, 15-16% of global GDP. And those bank deposits are the counterparts to all that credit that's been created over the last 15 years. And that credit has funded the tall, shiny buildings, but also all of that excessive property development and speculation in the residential sector. And I think the population knows that a lot of those developments are not really worth anything. The banks are never going to get paid back. And actually, there's a big risk to the banking system because of all of this debt that's lying around in China. Much of it isn't even serviced anymore. The interest is added to the principal, rather than admitting the loan is bad. And so what we're noticing, if we perhaps go back to the previous chart, to the previous slide, is that people are taking their money out of China's banks. Some of that money leaks abroad. China's leaking about $1 trillion in capital, $1.2 trillion in capital outflows. But most importantly, people are taking their money out of the banks, taking it out as physical cash and stuffing their mattresses, putting it in safes. It's not a 1920s style bank run where they're queuing around the block. It's more, I suppose, civilized. It's slower than that. But this is a big problem for the Chinese banks, that you're losing your cheap financing. So you can't make loans when the financing for those loans is walking out of the door. It's a concern for the central bank. You can't go around cutting interest rates aggressively when people are showing that they don't want to hold money in banks anymore. They need a positive deposit or a reasonably high deposit rate to try and keep that money in the system. So China's finding it very hard to ease. And actually, as the banks run into capital problems because of the bad loans, but more importantly, because they're losing this cheap source of funding, we're finding that Chinese credit growth is weakening. It's continuing to soften. And if we do move on to the next slide now, it's got to the point where the amount of lending in China is less than the corporate sector's annual borrowing requirement. So even if there were to be no mortgage lending, no consumer credit lending, no lending to the government, the banks don't have the capacity to meet credit demand coming from the corporate sector. So that corporate sector is facing quite a demanding, quite a hard budget constraint, which means you've got corporate austerity. And that's before the tariffs. If the tariffs do take effect and perhaps the Chinese corporate sector is hit by 3-4 trillion RMB, as is quite likely if the tariffs are as advertised, then you're going to be looking at something approaching a 10 trillion unfunded corporate sector deficit, which is an awful lot of austerity. To scale that, that's roughly twice the severity that the Japanese corporate sector faced in the mid-1990s. So you're going to get, I think, quite significant weakness. And it's a weakness that it's very difficult for the authorities to react to, because if you cut interest rates, more money will leave the banks. The banks are in a worse place. Perhaps more money would leave China. The currency could free fall. If you print more money, if you create more deposits in a system where people already don't want those deposits, you're running the risk with creating a financial crisis. That's pretty much what happened to Thailand in 1997. So I think the Chinese authorities don't have much room for maneuver. So we do have a weak Chinese economy. But this does give Xi Jinping, I think in particular, the incentive to play hardball with President Trump, because he's sort of creating an alibi for himself. And also geopolitically, I think many people in the region are probably looking at the US as a less than reliable ally now. Certainly Taiwan, I think, will probably realize that the US wouldn't rescue them if there were to be an event. That even in terms of the economy now, the US isn't on their side, so they're going to have to gravitate towards China. And I think this notion that the US is perhaps pulling back from Asia, the smaller Asian economies are going to have to gravitate towards China anyway. That probably emboldens Xi Jinping as well. So I think we'll see continued, maybe the sort of a head-to-head, as it were, between Presidents Xi and Trump. Clearly, President Putin doesn't seem to want to be playing ball in Ukraine. I think he wants to take on the deal-making reputation. And Europe and Canada are being quite aggressive when it comes to negotiations. So I think while we might have a period of calm in markets for the next month or so, all of these things will continue to bubble on. And particularly if we get that bond issuance round about June time, I think that could crystallize a lot of fears in markets, and we could see some softness. Now, ultimately, the US isn't going to, I think, bow down quietly to having a recession. At some point, China will have to ease. As I mentioned, the European Central Bank is already backing towards quantitative easing. The Bank of Japan has already started to pivot away from its hawkish bias. We've seen that this week. And I think actually within 3 to 6 months' time, we'll see the Bank of Japan certainly not raising interest rates, but actually backing QE. So I think by the end of this year, in response to the economic weakness and this pressure that we'll see on yields in the middle part of the year, that more and more central banks will gravitate back towards quantitative easing. We'll start printing a lot of money again. And as we saw during the pandemic, when that happens, you tend to get inflation a year or 18 months later. So I'd be looking for inflation to reappear in the world mid-2026 onwards. So this is, I think you're going to have to be quite active in this world. Probably not too much to do in the near term, maybe a little cautious, and then looking for the QE rally. But then as that QE becomes inflationary, that's clearly bad news for bonds over the longer term. And I think at that point, as we get into late 26, 27, country allocation is going to matter much more than it's done over the last 40 years. It's part of that repatriation story that we're moving to favour savers and the fiscally prudent over the rather more spendthrift governments. And I think we'll be looking for hard currencies, countries that have long-term financial stability, have the medium-term financial strategies, the sort of Japans of the late 1970s. So I think it's going to be a very active time, certainly a difficult time for passive money. And also, I'm expecting a very difficult period. In fact, it's already started for the private market. So private equity, private credit, already quite a few signs of distress in that sector. So I think the public markets will tend to outperform the private markets, but it's going to be quite volatile. And I think we're going to go through stages about worrying about recession with higher yields, then quantitative easing, then worrying about inflation coming back in a year, 18 months' time. So I think this is going to be a time when you've got to be on your toes, you've got to be quite active, but hopefully we can manage our way through it. So I don't know if there are any questions. There's a few other charts in the presentation, but I think they're probably the most important ones that we run to, particularly that China facing a binding financial constraint on its growth finally.
Hey, thanks, Andrew. That's awesome. Great rundown. Thank you. And you're breaking the mold about the English in Italy. So late dinner and still up late, which is good. Just the question I did have was regarding austerity. So, corporate austerity, corporate uncertainty is the most logical and direct and immediate response we're getting, I would say right now. Do you see any areas, or is that a global problem or simply a US problem? So is it too soon to see any other economy or any other market being able to carve themselves out and have more certainty than with what's happening in the US?
I think there's the odd special case. I mean, we've toured through Europe, and I've sort of been doing a little bit of work as we've gone through, and certainly Germany, I think, is just paralysed. Perhaps a little bit of a rabbit in the headlights there. There's a couple of places in Europe that seem to have a little momentum. Actually, North Italy has some momentum, but most of all, Spain. It's very competitive. Its exports are much more to Latin America, so it's avoiding what's going on in Eastern Europe and less affected by what's going on in the US. So there's a few economies there, but certainly as I toured the US after I was in New Zealand, it was very apparent that the corporate sector was just frozen. A lot of companies, and we've now seen this in the GDP data, had imported an awful lot in the couple of months prior to the tariff announcement, thinking that they could then sell it, but retail sales haven't lived up to expectations. So got a lot of we came across a lot of anecdotal evidence, and it's now coming through in the data of companies carrying excess inventories. I actually I went to see one of the major banks and crossed over in the waiting room with a fairly senior guy from a car company who was pretty much trying to sell me a pickup truck because his inventories of pickup trucks in the US were 4 times their usual level. And he was in the bank looking for basically inventory financing and extra financing to buy some property to actually keep them all in. And I don't think it was just, I don't think that was a particularly isolated case. So in the US, it's not just the economic uncertainty. Attempting to live with the uncertainty and forestalling the tariffs has had a very big impact on corporate cash flow. In fact, we're looking at corporate borrowing is growing at an annualized rate of 30% at the moment since the inauguration. And that's very much a reflection of companies have been caught trying to build up inventory in the uncertainty, but then not having the final sales to justify the inventories. And that really is just very expensive for them.
Awesome. I did think when the lights went out the last time, you had about 13 minutes until it happened again. So I think that's a sign. Thank you for the update. Thanks for making yourself available for us. I think there's some quite interesting parts that will reflect over into what Ian may well talk about and also Tim in terms of corporate uncertainty. So thank you for disturbing your tour, Andrew, and we'll go over to you. Good to have you, Ian. We're with you now. Thanks.
Thanks. Take care, bye.
Thank you, Stu. Sometimes I feel like I should say something happy and cheerful after listening to Andrew, but I do have some good news for bond investors, of course. But so if there's one word that sums up what's been happening over April, of course, that is uncertainty. Of course, 2025, the year of the tiger and the Chinese zodiac, is meant to be a special year for them, but in a brash move, obviously, Trump has the tiger by the tail, and I think, unfortunately, he's not really quite sure what to do now. So what we've seen effectively is a spillover of that uncertainty from US policy actions flowing through to financial markets. So early in April, markets were very volatile. We saw that both the US and New Zealand 10-year bond rate gyrating at about a 60 basis point range. S&P down 15 odd percent, but thankfully things have recovered. But also what we're seeing is that a much greater uncertainty around central bank actions going forward. So previously central banks have been quite explicit in their guidance, but now you're seeing them move to a stance where they're becoming much more data dependent around a relatively wide range of outcomes. So I think what that really means, for the real world is that in times of heightened uncertainty, people naturally become more cautious. So that means that consumers are likely to spend less, and also businesses are less likely to invest as well, less confident about the future. And you just see that reflected in the New Zealand Business Confidence Survey, quite dramatic difference between the responses that came in early in April versus the tariff announcement versus the responses that came in later after things had blown up. Businesses were a lot more pessimistic about the outlook going forward, although current conditions were still reasonable. Also, with greater monetary policy uncertainty, Trump has also been, challenging the idea of the independence of the Fed as well, which has roiled markets to some degree. When you basically calling the Fed governor an idiot and saying that you know more than what he does, has also had the markets unsettled. And of course, the US economy is principally, 2/3 driven by the consumer. And when you're seeing these emotive headlines of, effectively empty shelves and stories that there's going to be no presents for Christmas, that isn't good for the US, although I will say it's, starting from a relatively strong position. In terms of, what does that mean for New Zealand? Of course, the US oscillates between being New Zealand's second and third largest trading partner. Obviously, in the New Zealand economy is highly leveraged to exports. But again, we have a relatively strong starting base that agriculture has been performing very well so far this year. And here comes the good news. So for the month of April, I'm pleased to say that returns for NZ bond funds were very strong. So the Nikko bond fund had a return of a bit over 1%, and the corporate bond slightly under 1%. Of course, those outcomes were driven by fall in interest rates. So short-end rates up to 1 year in New Zealand were down about 30 basis points, the 5-year around about 20 to 25 basis points lower, and longer rates around about 15 basis points lower. So although rates did initially bounce higher following the larger tariff announcements, by end of month we were lower again, and rates are now about 10 basis points lower in the long end than they were at the start of 2025, and 30 basis points lower in the front end. So NZ bond returns for long duration funds year to date are somewhere around that 2%. So a good outcome so far. As we've said in previous updates, we've been positioned longer. So the volatility, was more an opportunity than a crisis for our funds. So we took the opportunity to buy some longer maturity bonds when yields moved higher to cheaper levels. So just incrementally adding to that duration position in their portfolios. At the same time, we've also been mindful of having more liquidity in the portfolios with more uncertainty in the world. And what that means is, we're not necessarily a forced seller of assets at cheaper levels. And also it gives us the opportunity to buy bonds as well. On a relative basis, New Zealand certainly proved a much safer port in a storm, and we've seen that time and time again. Even though New Zealand is a smaller, more concentrated market, is a very high quality market, and we don't necessarily see the same gyrations in our bond or asset prices as we do in the rest of the world. So certainly offshore markets were at times becoming very dysfunctional. Even in Australia, the Australian bond market was almost effectively closed for 2 days. Very, very difficult to get anything done at a sensible level. But what we saw in New Zealand was, the markets kept functioning. We did see a widening in buy-sell spreads, but now, and also credit margins. But now things are pretty much operating as normal again. Credit margins on, 5-year banks were perhaps a little bit tight around that, 85 to just below 90 basis point range, and they're sitting about 5 or 6 basis points higher now. So over the medium term, that should lead to a higher yield on the portfolios and a better outcome. Also, the New Zealand bond market, of course, has been underpinned by quite a shortage of supply relative to demand. So that just keeps us, I guess, performing a little bit better than the rest of the world as well. Having a higher yield through quality credit is also one of the fundamental building blocks of our portfolio. So in uncertain times, we look at, I guess, what we think are the most reliable and consistent ways of adding value. So we remain supportive and buyers of quality credit into the market. Fortunately, over the last 6 or 9 months, we had participated in most new deals that came to market. So we're well invested. The shortage of primary and secondary supply in the market hasn't been a problem for our funds at all. Another thing we've mentioned as well as a building block of performance going forward, of course, is the steep shape of the New Zealand yield curve. So longer New Zealand rates are much higher than short-term rates. And that's been an outcome of two things. Obviously, the Reserve Bank has been cutting the cash rate to try and stimulate economic activity. And at the same time, there's 2 or 3 things that mainly influence the shape of the yield curve. So the first one of those would be supply. Obviously, there's been a much larger supply of government debt in New Zealand as there has been in the rest of the world. So we don't think that fiscal pressure is going to go away in the US, but if continued supply. But of course, in New Zealand, we're hopeful that we're getting closer to peak term funding. In fact, the NZ DMO has reduced its weekly bond tender volume from 500 mil down to 450 mil a week. So that's some positive news, and also had several very successful syndications where they issued large volumes of bonds and tranches over the last 6 months to the market. They're well supported by offshore. Also uncertainty that leads investors to want a higher return if they're investing longer. So typically, longer credit margins will be higher than shorter credit margins. But at the same time, as uncertainty is increasing in the world, typically that's an environment when interest rates are going down as well. So that's sort of a +1 -1 relationship. And the last thing, of course, and most importantly in recent times, has been inflation expectations. So in New Zealand, inflation is around about that, just slightly higher than the band, middle around 2.6. But the Reserve Bank has, greater confidence. Going forward, the latest comments have been that they think the overflow of the tariffs for New Zealand will mean that growth is slower and inflation is lower as well. So we've already seen, crude oil prices are down 15% in the last month and a bit. And of course, also helpful in terms of tradable inflation is that the New Zealand dollar is around about 10% higher than its recent lows. So it basically helps for the things that we buy into the country. Talking about absolute moves of interest rates, look, as I said, the Reserve Bank thinks that these things will be growth negative. Also, there's a long way to a lot of wood to chop yet as to what it does actually mean for New Zealand. But the market has priced an increased likelihood that the cash rate going through neutral, so going lower than sort of 3.25% or 3%. Of course, the cash rate is currently 3.5%. Expectations are that there'll be another 25 basis points cut at the end of this month. But the market has actually moved to pricing a terminal cash rate of a little bit under 2.7%, which is relatively aggressive. And also they've moved to the thoughts that the cash rates will be lower for longer as well. Mortgage rates have been stuck around that. The specials have been 4.99 out to 2 years, and we haven't seen any improvement on those rates for some time. But I guess there is some slim hope that if the cash rates do go lower into more stimulatory territory and stay there for some time, that we may get some modest reductions in mortgage rates as well, which should help the consumer. We had the Finance Minister Willis out commenting earlier this week, just around the upcoming budget. She mentioned that Treasury is likely to downgrade their growth forecast, and also that the government will effectively be spending less money. So there's not going to be a great stimulatory fiscal impulse to the economy. So effectively, what she's saying is that the ball's back firmly in the Reserve Bank's court in terms of trying to stimulate activity going forward. So with all that background, I guess what we concentrate in an uncertain world is on things that we think are most likely to be consistent value adds of the portfolio. So I've said, investing in quality credit to try and maintain that higher yield on the portfolio, with the New Zealand credit market very resilient. Also, the steep shape of the yield curve. We think over the medium term that the funds will benefit through that carry and roll. If the cash rate does get down to 3% or lower, and your long-term rates sort of 10 years plus are 4.5%, or even at the back end 5%, then those rates are going to look very attractive as people seek higher returns. And of course, ultimately, we think that uncertainty will be probably beneficial to a lower interest rate structure going forward, although it may be quite a rocky road. And I'll just pause there and see if there's any questions.
Yeah, thanks for that, Ian. Great update. I guess the key question, or just the key observation, which I feel I know the answer to, but it's worth reflecting upon. So everything to do with flows and markets, basically there's no disruption to the markets and flows and how they're operating at this point in time. Is that it's an issue that people might worry about, but can you give us some comments about how everything's flowing through our funds and into the markets, please?
Yeah, so in terms of bond and cash markets, New Zealand's returned to fairly much normal state of play. Even early in April, when the rest of the world was melting down, it certainly wasn't anywhere near as bad as what we saw early in 2020. In the period of COVID, where markets became very dysfunctional. I said there was some widening of spreads, but New Zealand credit markets didn't move dramatically wider, and I guess it's underpinned by the quality of our issuers, who aren't necessarily highly negatively impacted by this tariff rate regime. We've been running higher levels of liquidity in their portfolios, so slightly higher cash. And we think that's important because, when you get large drawdowns in other asset classes, often people will look to fund them through their best assets, which are cash and bonds. So we may get asked to, sell assets, and we don't want to be in a position where a forced seller. We want to have some flexibility, I guess, to be an opportunistic buyer when yields are higher or prices are cheaper. But the portfolios are high credit quality. We've got plenty of liquidity, so we'll just wait and see what opportunities there are going forward.
That's perfect. Thanks, Ian. Yeah, it's the bond team, for everyone who's on the call, have been very consistent in pointing out the exceptional quality and function of the New Zealand market, which is should be a source of great comfort to everyone on the call. Hey, thanks for that, Ian. We'll go over to Tim. Thanks for joining us, Tim. We're covering the whole globe today. So Ian was in the office. Andrew Hunt was in Northern Italy, and Tim's in northwest Rodney County, which is part of Auckland City. Got a bit of a cold, but we appreciate you joining. Tim, over to you. Thanks.
That's right. Thank you, Stu. I've got a slide pack to share. So if Gemma, if you wouldn't mind, just putting the first slide up. So just to kick off, uncertainty is certainly the word of the day from my point of view. There's a lot going on in the world at the moment. When I was preparing for this, I was wondering what I should speak about, but I decided to keep it simple. We've got a reporting season coming up. That's where the uncertainty theme is going to come through from my part. Also want to talk about Ryman. Ryman did a large capital raise at the start of the year. We're overweight in Ryman. The stock has not performed well since then. It's been a large detractor. So I just wanted to talk through those issues with the group and talk through why we're still positive on Ryman and the retirement sector in particular. And then I'll touch on performance, which has been a bit of a struggle so far this year, although the April numbers, we are ahead, which is pleasing. So maybe, Jimmy, if we could go to the first slide. So just some comments on the reporting season coming up. I've got some bullet points there. So reporting, pardon me, reporting for New Zealand listed companies will kick off in a couple of weeks. So if we think about where we started the year to where we are now, our thinking about the outlook has changed just because of uncertainty around how the global economy performs from this point. And it reminds me of the COVID period, actually, where uncertainty was a key theme there. So during COVID, what we found is that companies weren't able to provide any meaningful guidance or forecast just because they didn't know how earnings were going to evolve through such an unprecedented period. And I think what we're experiencing now with these global trade wars and these other issues will be similar in that way. So companies need certainty in the trading environment in order to plan, invest, and forecast. So with the chopping and changing of things, which I think is the most unhelpful part of what we're going through, the lack of clarity around objectives with these things and with US trade policy in particular, and the conflicting reports around progress of trade negotiations, it's just impossible to have certainty in that trading environment. And that certainty that companies need in order to plan for the future just won't be there. New Zealand's a small trading nation, so the global economy plays a significant role in the shaping of performance of New Zealand's economy. Key factors I've got listed there. So just uncertainty around global growth rates. So any slowdown in global growth, which has been forecast, that should, you would expect that would impact New Zealand's export-driven economy in some way. We have uncertainty around global rates, particularly in major economies like the US and Eurozone, where central banks could have the tricky task of managing not only inflation, but economic slowdown at the same time. Relative for New Zealand as supply chain disruptions. So New Zealand companies rely heavily on global supply chains, and any disruption to this, as we saw through COVID, increased costs, it impacts inventory levels, it impacts margins, and so on. Thinking about investment in CapEx, so when companies want to plan for the future, if they want to invest, they need certainty to be able to do this. So uncertainty will mean that companies' investments will at least be dialed back, if not postponed. So making multi-year investment decisions in such a fluid and changing environment will be really, really tricky. And then I'm just thinking about a transition period. Uncertainty about where this all lands, I suppose, that'll be the transition period that we go through. So when we think about New Zealand products, the things we sell should remain in demand, particularly our soft commodities. It's the things that people eat. But should there be a reordering of global trade, this transition will cause some headaches. We're not going to be immune from that, although I do think we should be protected to some extent, just given the types of things that we do sell to the world. And actually, as I prepared all this overnight, there have actually been some positive global developments. So some tech companies have their stock prices have performed well, as we've seen some components being carved out from the tariff regime. And also reports from Chinese officials saying that the US administration has reached out for talks and that China is open to this. So those are positive things. Hopefully we see more of that. When we think about the NZX 50, one thing that we note is that it doesn't necessarily reflect the New Zealand economy, and it's quite different. So it has different earning drivers, and it's quite defensive by nature. So there are really only a few companies in New Zealand that are impacted by tariffs. So the likes of Fisher & Paykel Healthcare, Scullerup, Kathmandu, they'd be top of that list. But when we think about the companies that we're interested in the reporting soon, we think about companies like the gentailers, the retirement sector, listed property companies, and then other companies like Mainfreight and Gentrack. So these companies don't have earnings that will be directly impacted by tariffs, but they will be impacted by New Zealand's economic performance. And there's just uncertainty about global performance. And as I've said, that will flow through to New Zealand in some way. So in summary, the upcoming New Zealand reporting season, it's set against a backdrop of really complex global economic factors and trade wars. We expect uncertainty around global economic outlook to dominate forward-looking commentary, much the same as it did through the COVID period. Jim, if we could go to the next slide, please. So just this slide here. So this is a a chart that we received from one of the stockbrokers that we deal with. We find it quite helpful. So it shows how the December year-end reporters performed versus expectations when they reported earlier in the year. So if you just have a look there, the far left column, so EPS results versus expectations, so 9 were below versus 9 above and in line combined. If we go over to, if you have a look at post-results EBITDA and post-results EPS, financial year 26 revisions, you'll also see that there are more downgrades than upgrades and unchanged. So just worth keeping in mind, this was before Liberation Day and it was before the trade war. So it's just something to keep in mind as we enter this new or the upcoming reporting season. Although another thing that has popped up, and I'm going to read this from my other screen, we had an announcement from Mainfreight today, and I'll just read the quote as read. Our full year accounts are currently being finalised and are yet to be audited. However, it is our expectation that full year profit before taxes and sales revenue will be above market consensus expectations. So that's good news from Mainfreight, who will be reporting later on in the month. Jenna, if we could flip to the next slide, please. So this has just been my section on Ryman Healthcare. So I'll start by talking about the capital raise. So we've just got some points there, which I'll let you read. So Ryman Healthcare recently raised $1 billion in equity capital. The aim of this was to reduce debt and improve financial stability. So along with the equity raise, we received a trading update from the company. It's fair to say that the trading update was a mixed bag. Some areas showed positive progress, but other areas clearly facing challenges, including sales of newly developed units. From what we understand, trading has improved since that update. Ryman are reporting this month, so I'm looking forward to getting more information about that and being able to confirm that trading has in fact improved since that update. From the market's point of view, I think the thing that was missing from the capital raise was good communications around the growth strategy post-capital raise. From the company's communication, certainly the initial communications anyway, the market read that Ryman had gone ex-growth, and I believe that's reflected in the price where we're trading today. The company's come out since then to attempt to dispel that. But the fact of the matter is they're going for a large company-wide strategic transformation and they're unable to communicate to us exactly what growth will look like in the future. This is another thing I'm looking forward to learning more about at their upcoming result, although I don't expect that we're going to get the full picture of what growth looks like at the result. But things that we could see that growth becomes focused on Victoria and Australia as opposed to New Zealand. Another thing we could see developing of smaller greenfield villages and acquisitions of existing villages, stepping away from the large-scale capital-intensive developments that Ryman's undertaken in the past. And then we could also see extensions of existing villages, so Ryman making the most of what they already have. What we don't expect to see, and what we've confirmed with the company, is that we won't see several large-scale capital-intensive projects on the go at one time. It was this approach ultimately to growth that became unsustainable from a financial point of view and resulted in the issues that we're in now. Next slide, please. So just the changes that we've seen at Ryman. I've got them listed. I'll just make some comments. So on the board and management refresh, we view new CEO Naomi James really positively. We know her well from her time at Channel Infrastructure, and we think she's the right person to lead Ryman through this change and into this new stage. Thinking about the pricing structure is now aligned with the rest of the market. The weekly fees have been increased, and the deferred management fee has been adjusted up to meet the market. We're supportive of these changes. Initially, I think what Ryman found as they put these changes through was that it impacted sales late last year, but I think that from what we hear, that's settled down now. Making these changes and bringing them to market is a good thing. What we found, especially through inflationary periods with the fixed fees, in particular where they were, was that structure became just unsustainable. So yeah, we're positive of that change. We have revenue recognition changes. So revenue recognition is now aligned with actual cash receipt of sales. So that's more reflective of what's going on in the business. So that's positive. And then we have the wind down of the large in-house development team. So this is a huge strategic change, but it's one that's going to reduce a really large fixed overhead for Ryman. So it's in this way that it's most obviously observable that Ryman's changing its growth strategy. It does present some strategic risk, and we're keeping a close eye on it. It's something that's going to progress over the next few years. So yeah, something to keep in mind. And then finally, just the cost out and the reduction in corporate overheads. So when we think about cost out, particularly for a company in Ryman, brand is something that we keep in mind. We wouldn't want a cost out program to impact the resident experience in any way and therefore damaging the brand. And the last few times we've caught up with Ryman, we've made that clear to them. And they're certainly on board with that too. They think they can extract costs from the business without impacting the residents. Gemma, next slide, if you wouldn't mind. So we remain overweight Ryman. So on the slide, what I'm trying to show is just how cheaply Ryman is trading compared to in the past. So on a price to NTA basis, Ryman, to me, looks far too cheap and far too oversold. So there's probably a few reasons for that. The size of the capital raise would be one of them. So the size of the capital raise impacted the price just because local investors participated in that raise. They've absorbed $1 billion worth of stock, and they're probably not in a position to add to any positions in any meaningful way. Another thing that I think is holding the stock price back is just, again, that clear communication around the growth strategy. I think once Ryman's able to communicate that to the market, the stock should begin to perform well again. Something encouraging is that we recently saw a large line of Ryman stock sell. So there was 40 million shares sold at $2.20. And what we were encouraged by was the fact that this was done in one line. And what that tells to us is that other investors see value here. So if we, as I've got in that little table there, as we see the company begin to communicate a good strategy, we think that price to NTA ratio improves, and that just flows straight through the share price performance on that upside potential part of that chart. In terms of valuation, so when I think about forward valuation for retirement village companies, NTA growth is really important. And for Ryman, that's quite hard to think about at the moment, just because we're not clear on what that growth strategy is going to be. So it's really hard to forecast how NTA is going to evolve and grow from here. I'm just looking forward to Ryman's upcoming result to hopefully start to put these pieces back together again, thinking about NTA and growth for the company. Next slide, please. So further to, we like Ryman for specific reasons, but we like the sector. I think the two main drivers for our attraction to the sector is there's fewer RV units being consented, but we have an aging population. From an aging population graph, you can see that the over 65s are growing at a faster rate compared to the rest of the population. So demographics are going to be a major driver for the sector. Listed operators will be boosted by the fact that there are fewer units being developed, and just those supply and demand dynamics will be in favour of the retirement village operators. And then finally, just thinking about the housing market. So when the housing market performs well, the retirement sector tends to perform well. The housing market had been showing some signs of stabilising, and the hope was that we'd see some positive momentum throughout this year. We have these global growth concerns, so maybe that story gets pushed out again, but the things that are supportive remain supportive. So low rates, as the M was saying, and mortgage rates at those low levels and potentially going a little lower. Gemma, just the last slide, please. So just last slide on performance. So I saved this until last because Ryman's been a large detractor for us in the first few months of this year. And I just wanted you to have that context before I showed you the performance numbers for the year to date anyway. There have been some other names which haven't worked quite as well, but Ryman certainly stands out. Sparks detracted. Sparks, it's fair to say they're probably under-delivered on their strategy. They've got a couple of little governance concerns. Michael de Cesare's working really hard with the company to try and help to address them and get the company returning to form. And look, beyond that, short-term performance numbers, the April numbers we're quite happy with. We're ahead. We still have conviction in our overweights. We think as we move through this phase and ultimately into recovery, the portfolio should perform well. And I'll leave it there, open to any questions.
Thanks, Tim. There is a slightly technical question online, so I've just screenshotted it off, and we'll send that out to the person who's asked that. It's just attributing impact in the slowdown in sales to the general property market. Just a couple other comments I just wanted to make, though, was just, again, just a reminder of the presser online, in particular on some of the stuff that Tim's been talking about. Come back to us if you want to quote it directly, please. The other thing I was thinking about Ryman was I was just recalling that Naomi James and James Miller worked together at Channel Infrastructure as well. Yeah, which I think is probably a positive.
Yeah. It is, yeah. And in fact, we recently caught up with James In his capacity as chair of Channel, but we spoke to him about Ryman. Pretty positive conversation in terms of where they've been and where they're going, and he's certainly across the numbers and across the strategy, so we have confidence in him too.
Yeah. And the other thing I was just thinking about when you're talking about like revenue recognition, I think that's something that you've looked at for a hell of a long period of time, and you're absolutely right about it. Just weren't quite as precise on the timing of it being sorted out. So that's good. Anyway, hey, thanks everyone. Thanks for that update, Tim, and thank you everyone for joining. And just regarding that, the Ryman question, I'll send back the answer when we get to the bottom of it directly. So everyone, have a great weekend. Thanks for joining us, and we appreciate your support. Good morning.